Welcome back. We're jumping straight into the BlackRock TCP Capital Corp Q3 2025 earnings call. And for you experienced investors, you know what we do here. We cut through the noise to find the actionable insights.
And this quarter, it's all about what we're calling the Great Credit Cleanup.
Exactly. It's this fascinating tension. You have management scrubbing the balance sheet on one hand.
And on the other, they're plugging into this just massive deal sourcing machine from BlackRock, a really interesting dynamic.
So let's start with the top line numbers for Q3. The foundation, net asset value, the NAV, was basically flat quarter over quarter.
Held steady at $8.71 per share.
And their core earnings, the net investment income, or NII, that came in at 30 cents per share.
Yeah, that was a little dip from the 31 cents last quarter, but, it still comfortably covers the dividend.
Right, and the board declared that base dividend at 25 cents. So very steady there.
Been paying that since Q1, so no surprises for income investors on that front.
Okay, but a key sign of confidence, or maybe just a reaction to the stock price, was the share buybacks. They really stepped on the gas.
They absolutely did. I mean, they were actively in the market, which tells you they think the stock is undervalued.
So they bought back, what, about 25,000 shares during Q3?
Yes, but that's not the real story. The big move was right after the quarter closed. They scooped up another 170,000 shares.
Wow. Okay, so that's a much more aggressive signal to the market.
It is. That puts the whole quarter in context. So while the market might see the flat NII and think, mixed result.
You're saying the real story is under the hood, in the credit quality.
Exactly. This was priority number one for them all year, and they actually did it.
So let's talk numbers. The non-accruals, the loans that aren't paying interest.
They dropped to 3.5% of the portfolio at fair value. I mean, to give you some context, that's way down from the 5.6% they were wrestling with at the end of 2024.
So that shows real progress. They're either fixing or getting out of their problem loans.
It shows execution, plain and simple.
And there's a big but here. All that good work is kind of overshadowed by what they've flagged for next quarter.
The Renovo situation.
The Renovo write-down.
Yeah, that's the bitter pill. And it's why the market is, a bit cautious. They were very clear.
How clear?
They said Renovo started liquidating in early Q4, and they expect a full write-down.
And what's the damage from that?
It's going to hit the Q4 NAV by about 15 cents per share. So yeah, Q3 looks clean, but Q4 is already taking a big hit.
Okay, let's unpack that then, the operational side of this. They had one big win and one big loss that really defined the quarter. Let's start with the loss, Renovo.
Right. Renovo was a direct-to-consumer home remodeling business. Not a huge position, about 0.7% of the portfolio.
And they had tried to fix it before, right? This wasn't a new problem.
No, it was a restructured credit. But they said the failure was due to, quote, issuer-specific performance and liquidity issues.
Which is a way of saying the company's problems were just too deep to fix, especially in this macro environment.
I think so. It just highlights how tough these turnarounds can be. You can't save everyone.
Okay, so that's the loss. Now for the counterpoint. The big win that propped up the NAV this quarter.
NEP Group.
The NEP Group restructuring. This is where having the BlackRock muscle really comes into play.
Oh, absolutely. This was the highlight of the quarter operationally. NEP is a huge global player in broadcast services.
And the deal was complicated, but the outcome for TCPC was what?
It was spectacular. They managed to upgrade their debt position from a second lien into a first lien term loan.
So for you listening, what does that actually mean? Going from second to first lien.
It's like going from the back of the line to the very front. Second lien gets paid only after the first lien holders get all their money back.
So by moving up, they basically secured their claim on the company's assets.
They massively de-risked the position, fundamentally. And that successful move was the main driver, the lion's share of the $94.1 million in unrealized gains for the quarter.
So that one win basically paid for the Renovo loss and then some, at least on paper, for Q3.
It did. And it proves they can execute on these super complex restructurings, which is a critical skill right now.
Let's shift to the long-term story, because this is really about the BlackRockification of the portfolio.
Hey, I like that. That's a good way to put it. The goal is clearly diversification, making the portfolio more granular, and just lowering the overall risk.
And we can see that in the deployment numbers.
Yeah, since January, they've put $241 million to work across, 18 new companies and 13 existing ones.
But the really telling stat, the one that shows the new philosophy, is the average deal size.
It's a huge change. The average position size for a new investment is now just $7.8 million.
Just 7.8 million. And compare that to the average for the whole portfolio at the end of last year.
Which was 11.7 million.
That's a massive reduction.
It's not an accident. It is a very intentional strategy to build a portfolio where if one company fails...
Like Renovo.
Exactly. It's a small dent, not a gaping hole. That kind of granularity should, over time, warrant a premium valuation.
And they're sticking to their defensive posture. 89% of the portfolio is still senior secured debt.
All of it floating rate, too. So they're staying at the top of the capital stack and benefiting from higher base rates. It's a quality story.
And none of this would be possible, or at least not at this scale, without the BlackRock Private Financing Solutions platform, the PFS.
That's the engine driving all of this. It's the structural advantage that a smaller firm just doesn't have.
The numbers they gave were kind of staggering. A 20% increase in deals they reviewed.
And a 40% increase in deals that actually made it to the screening stage, quarter over quarter.
That is just a fire hose of opportunity.
It is, especially in a market where finding high-quality deals is really, really tough. They can be incredibly picky.
And it lets them drive down that average position size you were talking about.
Because they don't have to take a huge bite of every deal they like. They can just take the small, safe piece they want.
And we can see that in the new investments they highlighted.
We can. They mentioned a $2.4 million investment in KBR, a credit rating agency.
Stable, recurring revenue.
And a $5.2 million follow-on in Syndigo, a software company that uses AI for content management.
Again, very much on trend.
And both were first-lien term loans led by the PFS platform. It's the BlackRock playbook in action. Stable businesses, senior debt.
Okay, but there is a trade-off here. Let's talk about the yield. It dipped a bit, right?
It did. The weighted average yield on the portfolio is now 11.5%, down from 12%.
And that's because the new deals are coming in at a lower rate.
Exactly. The new investments yielded about 10.1%, while the stuff they're getting rid of was yielding closer to 11.7.
So they're giving up, what, about 150 basis points of yield?
They are, and they're doing it consciously. They're trading a little bit of income for what they believe is a much, much higher credit quality.
A safer loan from the BlackRock funnel.
That's the bet. It's a defensive move. It might press down on NII a little bit in the short term, but it should reduce the number of future Renovo-style blowups.
And on the expense side, good alignment with shareholders.
Very good. They waived a third of the base management fee for the first 3 quarters.
And no incentive fee this quarter.
Right, because the total return hurdle wasn't met. So when investors don't make money, management doesn't get their bonus. That's how it should work.
So let's connect all this to the bigger picture. What are they seeing out there in the market? Is M&A back?
They said the pipeline is growing and M&A is showing, quote, signs of life. So optimistic, but
Good cautious?
very cautious. They confirmed that most borrowers are not doing big transformative acquisitions. They're just refinancing existing debt.
Trying to lock in better rates or push out their maturity date?
Exactly. So refinancing and little add-on deals made up almost half their deployment recently.
So even with their deal funnel up 40%, the volume of really good new M&A deals for the whole industry is still pretty limited.
Precisely. Which again just highlights why that BlackRock fire hose isn't just a nice to have. It's an absolute necessity for them right now.
Okay, this brings us to probably the toughest question from the analyst Q&A.
Mm-hmm.
An analyst pointed out that 3 of their recent restructurings, including Renovo, have failed to, quote, stick. They've gone bad again pretty quickly.
And they asked what the common theme was.
Right. And management's response was,
What? They expressed disappointment, but they were forceful in saying there was no commonality among the failures.
but wait a second. If 3 different companies in 3 different industries all fail shortly after you restructure them, isn't the common theme?
Yeah. That is a fair challenge. It does seem like a bit of a stretch to say there's no commonality. The market is looking for proof that this round of credit cleanup is going to be more durable than the last.
So management is basically asking for trust, saying NEP is Exhibit A, that we've gotten better at this.
While Renovo is Exhibit B, that it's still really hard. It did acknowledge that these failures are painful.
Well, they're clearly not complacent about future risks. They talked about what they're watching now.
Yes, and this was interesting. Of course, they're watching cyclical businesses that would get hurt in a slowdown.
But the new thing was technology risk. specifically AI.
This was really insightful. They're not just asking if a company uses AI, they're asking if AI could displace that company's entire business model.
Or, on the flip side, does the company have a strong AI solution of its own that gives it a competitive moat?
Exactly. That's a very sophisticated level of risk analysis that you don't hear from every BDC.
A huge signal for where private credit is headed. Okay, quick liquidity check before we get to our trade idea.
Yeah.
Balance sheet's still strong.
Very strong. $528 million in total liquidity. Leverage is at 1.2 times, which is right at the top of their target range.
So they're using their capital efficiently.
They are. And they're already planning for their 2026 debt maturity. So no surprises there. They're on top of it.
All right, let's move on.
Okay, and a very important reminder for everyone listening. This next segment is for informational and entertainment purposes only. It is absolutely not financial advice.
Always consult your own financial advisor. Okay, welcome to the Trade Ideas segment, where we pitch an outrageous but plausible thesis based on what we just heard.
So the thesis here is all about the growing gap in private credit. You have the big players with institutional deal flow, and then you have everyone else. We want to bet on that BlackRockification advantage.
So we're structuring a paired trade. We're calling it the refinancing arbitrage defensive growth pair.
The goal is to go long on superior deal sourcing and diversification while shorting the very risks management told us they're worried about.
So the long side of the trade is TCPC itself.
Right. The bet is that the market hasn't fully priced in the value of their improved sourcing and that dramatic reduction in concentration risk. Going from an 11.7 million average deal to 7.8 million is a fundamental de-risking of the whole book.
And as a senior lender, they still benefit from high rates on all those new, safer loans coming through the PFS funnel.
Even if the headline yield is a bit lower, you're getting paid to be safe. We're long institutional advantage.
Okay, so what's the short hedge? It has to be very specific.
It has to hit those twin fears: technology displacement and refinancing risk.
So you're looking for a small cap company.
A publicly traded, highly leveraged small cap company in a space like, say, legacy enterprise software, the exact kind of business that is vulnerable to being displaced by AI.
And crucially, one with a big pile of debt coming due soon.
Yes, a big maturity wall in 2025 or 2026 that will force them to refinance in a tough market.
So the idea is, if refinancing costs stay high or go higher, that company gets squeezed. The short position pays off.
While your long position in TCPC just keeps humming along, collecting its interest payments from higher quality borrowers and deploying capital into even better deals that PFS surfaces from the fallout, it's a bet on institutional strength winning out.
A fascinating structure. Okay, to wrap this all up, we covered the flat NAV, the huge win on the NEP restructuring, but also the coming Q4 headwind from the Renovo write-off.
And really, the central theme was the strategic shift powered by the BlackRock PFS platform. That deal flow is everything now.
But the final thought, the real question for you to dig into.
That's about durability. How many of their current credit fixes are actually going to stick this time?
Right. They got the non-accruals down to 3.5%, but given the recent track record, you have to ask.
Is that 3.5% truly stable, or are there more Renovos hiding in there that will pop up in 2026? Proving that stability is the real key to unlocking value from here.
That is where the risk and the reward lies. Thank you for joining us for this deep dive.
And please remember, this was all for informational purposes. Consult your own professional financial advisor before making any investment decisions.
We'll see you next time on Talk Tickers.